There are really two elements to defining a tax-efficient investment. The first is the actual tax rate. How much do you pay the government when you realize a profit? Are you paying ordinary income rates of 37% on those profits, or are you paying the capital gains tax rate of 20%? And the math is pretty simple here, but many investors fail to consider this in their evaluation of investments. A 12% return on an investment taxed at ordinary income only delivers a 7.5% after-tax return. A 10% return on an investment taxed at 20% actually produces a higher return, an 8% after-tax return. And to a taxable investor, the only thing that matters is how much you put in your pocket after taxes are paid, the after-tax return. The other and more important thing to consider about tax-efficient investing is time. How often are you paying taxes? Does your investment create a taxable event every year? Or can you defer those taxes until you sell? Because money that you pay to the government today is money that isn't working for you in your portfolio. And if you're evaluating two investments, you might think there's no material difference between a stock that grows by 10% per year and a debt investment that delivers a 10% annual dividend yield. But in reality, the difference is quite large. And the reason is simple. A debt investment creates a taxable event each and every year and is taxed at higher rates as well. A stock gain can be deferred until you sell the stock, and those gains are taxed at capital gains rates of 20%. So you get the power of deferring, compounding, and lower tax rates. This is exactly why Warren Buffett's wealth increased by $12 billion in 2016, but his tax bill was only $1.85 million. That's a 0.015% tax rate. He's famous for the saying that his favorite hold period is forever. His tax strategy is incorporated into his investment strategy, and it should be that way for every investor.